As we come to the end of March, the market's been through multiple events, from the Indian budget to the US Federal Reserve presenting its most recent meeting, a banking crisis, the Adani fiasco, and all that is now priced in the market. The question is what next? Because we actually at crossroads on this entire issue, because whatever's happening in the US, we can argue two ways. One is that you have a liquidity infusion happening, which has historically been supportive of markets. In fact, since October, many multiple rallies in the US markets have occurred at points of liquidity infusion, even though the Fed has continues to raise rates. So on the one side, raising rates is breaking something. On the other side, the liquidity is trying to rebalance that on a consistent basis. So what is really going to work? So we eventually end up looking at things like the dollar, and that's of course been declining since September, and even recently after the bounce back has been falling for a while. On the other hand, you have the Indian market, which sort of deviated from January from global equities, and then continued to fall. So this is actually the fourth month consecutive that it is actually down. Of course, the monthly closing is still a week away, but we are 4 months falling in this market, and that's one of the longest streaks, I think longest since 9/11. The only thing is, prior to 9/11, you had the Ketan Parekh fiasco, and then a long lag because leveraged trading was sort of put out of business with the Badla being removed, and the new FNO system was then introduced, and took a while. And then 9/11 happened, and that was the final capitulation point for at least the Indian market. US markets remained down for another year till they entered Iraq, and then picked up from there. So that's just history. Are we facing a similar situation? There have been a lot of events which are similar, but and then again, this banking crisis also, you can draw similarities with 2008. But at the end of it, what is different is that banks were also bailed out in 2009. There was a lot of quantitative easing which was done, which essentially meant buying a lot of the bonds, credit, MBS securities, and that liquidity went to the banks. So banks never had a liquidity problem after that, which means their funding is good. H2M is a different issue, which is also a fallout of the new rules that were introduced in 2008-9, that, well, you can mark a certain amount of the government securities as H2M. And that was already prevalent in India, so not a big issue. And that sort of is required because, there are certain securities which you are holding to maturity long term. And therefore, you don't really need to market and affect your profitability every quarter. And that's why it was introduced in India. You can the only thing is you probably need more regulation and limits in terms of how much security should be marked and not marked and so on, which is already in India. I think we saw that, and already those things are in place. But US tends to be a more free country. They just allow you to do things in your own way beyond a certain point. And that is where then regulation becomes required when there's a crisis. So back to the point, are we at a point in time where things are going to get worse because of the banking crisis, or are we at a point where we sort of discounted the worst, or at least for the time being markets are getting extremely oversold? So it's a mix of both, because on the one side, while we can extrapolate the banking crisis, the thing is, for the time being, a lot has been done to backstop this problem. And the real issue might not be whether you have a banking crisis, but really whether the US goes into a recession. And of course, that can have linkages with the banking sector. But at this point of time, the sell-off in US banks, the bank index, has actually not caused a major collapse in, say, other parts of the market, which is, if you look at the S&P, you look at the NASDAQ is holding out much stronger. And that's not what you would have thought. I mean, I had written about the US bank index probability that, it would do a wave C down in December. And then in January, it looked like the S&P would rally, which it did. But the bank index rally faded much earlier. And now what I thought in December in terms of the bank index has actually played out. But the surprise is that it has not played out along with a big sell-off in the US markets themselves. So why did that happen? Why do we have such a big divergence between these two? Partly because of the liquidity infusion. And so that is where the catch is. Do things get worse right away because you have liquidity infusion? or have we delayed the problem maybe for another 6 months? And that timing can be everything in terms of which direction of the trade you really take. Because if things start to look like they're improving for another 6 months, and then rates are higher for longer, and the eventual weakening of the economy shows up and drives the markets down months later, you have a long lead lag. Now, I'm not saying necessarily 6 months, it could even be 2 months. But the timing of it all is really going to be critical in the short term, because divergences are not necessarily good things. If only one sector moves and the other doesn't, it's the classic Dow theory, analogy that it's stated when if one sector of the market is doing well and not being confirmed by the other, then is it really a trend reversal? So in this case, when one sector is doing badly and the others are not doing as badly, then is it a trend reversal or a sign that the trend is in its late stages and probably likely to change? And so that's what we call an intermarket divergence. Now, our own market has very, very different sentiment signals. So I'll just share a couple of charts. One of them, which I've written about many times since December, is this one, which is the volume of puts traded to the volume of calls. You may have heard that in my multiple spaces or interviews as well, because this data actually was hitting new highs, the highest reading since 2009 till February. But in March, it has actually taken out the 2009 highs, which means we're actually trading more puts than calls. If you just look at this red point here compared to this line has been going up consistently. I thought this was already giving us an oversold reading, in Jan, Feb, but it's continued even higher to a level that we've not seen since here, which is the end of the 2008-9 bear market. That's when the readings were this high. But the markets are not that down, as they were. The news flow is as bad, but the markets are at an elevated level. And that really makes you question, why did that happen? But on the other hand, if it has happened, if sentiment is already so bad, are things going to really get worse? This is where the struggle starts in terms of understanding what markets are really doing, because there's enough bad news to say that things can get worse. But on the other hand, you have readings like this which can tell you that at least if nothing else, in the near term, it can mean that it's time for a relief rally. Even if it's not the start of a bullish phase, it can be the start of a stronger bear market rally as well. So both of the things you have to keep in mind. Now, this is not the only data point, because if there was a single data point, in Jan it was a single data point, but now much more has got added up. You may have heard of some of them, and I'll just go to another chart. And this one is the institutional setup, which is the participant-wise open interest, FIIs, and client is what this is reflecting. The blue line is the FII. And FIIs had a short position in the month of the pandemic, which had gone to almost 173,000 contracts here on the 6th of March. Of course, after that, the market continued to fall one way down and then only recovered. Now, that's also a time when, there was a ban on short sales. Sometimes people ask me, why did shorts not continue down? Probably market fell so fast that you wouldn't keep adding shorts after a point. You just held on or started to cover them as it continued to fall. Now, unless we are in that kind of a situation today, after 4 months, remember, this fall ended in 3 months. So the largest part of the decline in March of 2020 was the third month of that decline. We are now in the fourth month. Okay, so we've already fallen for 3 months till the first week of March. Now the fourth month is going on. And the short positions in the last week or two have gone up to an even higher level. 195,000 contracts is now an all-time record reading. The opposite of that is the client side, which includes HNIs, corporates, you can say operators, whoever, all kinds of large traders, not just the small ones. And so who else would take significant long positions when markets are falling or at the bottoms? And that's what it looks like here. 153,000, 56,000 contracts long is as high as it was in the previous occasions. Now this data is of course updated till I think it's still yesterday or day before, probably 22nd. I haven't put in yesterday night's data, but even there, I think we are just close to reading on the client side being at an all-time high. Just missing that by maybe a little bit, or just there yesterday. I have not, like I said, not checked on. But if I do check, I do have the data point here. So yeah, there, see, it touched 153, it came down to 151. Even yesterday, we've seen some reduction in shorts by FIs for the first time in many, many days. But like I said, these readings reached an all-time record. So at 153, the last high reading here was 159. So of course, client side is as high as previous, but not at an all-time record. But there's another one which is at all-time record, and this is the new participant which has become active since 2018, and that is the DIIs. It's hardly spoken about, but the DIIs now have the largest long position since COVID, since 2020, when it was almost 66,000. In fact, just before the tax breaks announced by the finance minister in 2019 year, we did have significant long positions by domestic institutions, almost 80,000 contracts long, and weeks before that it was close to around 76 or so. So right now we have a reading of almost 68,000 contracts long, which is as high as those previous readings. This one is an equivalent probably, which is way back in 2018 when it had fallen. This bottom occurred when DIs were long up to almost around 68,000 contracts. So that's the setup. And history always has shown that, which part of the market is right. People will try to think, oh, this guy is going to be wrong or that guy is going to be right. But history shows that near bottoms, DIs have already had the maximum long positions and FIs the maximum short. Whatever the reasoning be, FIs tend to be more hedgers rather than directional trades. They're not really shorting to short the market, which is how people misinterpret it. But it's just that when they feel maximum fear, they're probably maximum hedged, and that's where we read it as a sentiment indicator, that sentiment is excessively bearish, and therefore we may be getting to a point where markets can recover. The same with the volume PCR, which I discussed earlier. So I call these sentiment indicators. The idea of looking at sentiment is essentially to understand how the markets feel. So this is how the markets are feeling. They're feeling extremely nervous, most nervous since 2009, or 2020, which are two previous bear markets. But the decline in the market is not as significant yet. Will it get? Is not clear, because typically such extremes should mean the worst is over. The fear in the mind is only of whether the US goes into another crisis, and the question is now or after some time. So I think my sense is there's time in between, and that's where the trade will show up. We should probably wait a while before things get worse. Watch how the US markets and the liquidity situation unfolds, because rates are going to stay higher for longer, which is something which they've already said. Even if they stop raising rates, they may remain at 5.25% till the end of this year. And at some point of time, that can hurt the economy and slow it down to the point of or close to the point of a recession. So that is, I think, the risk, and the timing of it is what we really need to do. So that's all in this update. Thank you.